Good morning. My name is Thomas Breitinger, and I'm the Vice President Development of German-speaking countries from Maier, Vidorno, Altios, which basically means that we are responsible for supporting all our German-speaking clients with their internationalization. In the past, you may know, we only supported in market entry and market expansion services to India. And today we support our clients in more than 50 countries globally. Since our merger with Altios, we are the leading service provider for internationalization with more than 32 offices and in 22 countries. Most of our customers are already active worldwide with 3-4 foreign subsidiaries and an export share of 50% or even more, sometimes 80%. And very often, let's say, a topic for our customers is, so how can I increase my market share in a foreign market where I'm already present, maybe with a sales partner or even a subsidiary? So by taking over an already established company, this goal can be reached faster than by organic growth. And this is what it is about today. I'm happy that for today's event, we have 100 participants. And before starting, I wanted to give some technical information. So you're all unmute and or you're all muted, but you have the opportunity to write questions in the chat, which you will find on the right side of the control panel. We are looking forward to answering all your questions in the Q&A session at the end of the event. If you have more individual questions that you do not want to discuss in this event, please just send us an email. The webinar will also be recorded, and we can send you the recording afterward. Same goes for the presentation. So we will start our event with an interview of Oliver Thyssen, the head of finance and legal of the Trilux Group, and our managing partner Klaus Maier. He will do the interview. I leave the stage to you.
Yeah, Thomas, thank you very much for the kind introduction. And I'm also very happy to have Oliver Thyssen here with me today. And Oliver is the head, or nowadays you call it CFO, the Chief Financial Officer of Trilux, which is I think one of the leading manufacturers of lighting in Europe, and I think even in the world. Oliver, after his university in Betriebswirtschaft, if say in German, or business in English, started his career with Ruhrgas on the financial side, and then later on continued with Toyota until his voyage led him to Trilux. Yeah, and I'm very happy to welcome you here, because one of your responsibilities is that you are in charge of the corporate finance side, including mergers and acquisition for Trilux. And thank you very much for spending your time with talking about your experiences of a medium-sized business, what Trilux surely is. I mean, maybe you can just briefly introduce our audience to Trilux and your activities, so that everybody has a vague idea of what exactly you are doing.
Okay, Klaus, thank you very much for your kind introduction. I'm really happy to have the chance to be part of this event. And as you asked, I would give some slight information about Trilux. Trilux was founded in 1912, so we are close to 110 years old now as a family-owned company. That is very important that it is a family-owned company, because we have a limited possibilities to get additional equity. That is very important. For that, what we would like to discuss later. And thus, we have to be very careful with regard to that merger and acquisition issue, but nevertheless, it is an important step. And during the history of the company, we have done several acquisitions. We have also founded companies by ourselves. As it was already explained by Thomas Breitinger, it is always a decision how to continue, how to grow the business. But we did it in both ways. and with different results. To be very honest, we have had very successful stories with regard to acquisitions. We have had stories which were not that successful, and we have of course seen that we could really set up a new company and let it grow very successfully, and also on that way we had stories which were not that successful. So it is a very different business, and it is a case by case decision which you have to take. And yeah, we did it in Trilux, and as mentioned before, we are a company which is focused on professional lighting solutions for a wide, let me say, application series. We do it for offices, for industrial buildings. We do it also for roads and places. So wherever you see professional lighting, that means not lighting for decorative purposes like you have at home, wherever it is more technical based or business based, we are there, and we are, since I would say 2 generations now, market leader in Germany. We are the biggest not stock-based company in Europe for this market. And yes, it's a very closed market. So that means you know a lot of the players also in person. That makes the acquisition issue sometimes more easy, sometimes more difficult.
Yeah, thank you very much, Oliver, and for the introduction. I think in 10 years ago, 20 years ago, we would have said you manufacture lamps, right? Now
yes,
it's all about.
Hopefully,
now
you
it's
do
all
not
about
do it today
lighting.
anymore.
Yes. Yeah. Now it's about all obviously creating atmosphere through light and creating a certain environment through light. So very interesting. And to whoever comes to Cologne one day, Trilux is having a showroom here in Cologne, which actually shows you a different world, what you all can do with lighting. It was very interesting. But coming back to M&A, you mentioned it already that sometimes you start a company. I mean, I think you have like what 16, 17 manufacturing sites all over the world. You have,
No,
7,
sorry,
8 manufacturing. Yes. 7 manufacturing and 16, 17 sales organizations, sales
Yes.
and service organizations worldwide. Sometimes you started them from a grassroots. Sometimes you bought a company. Is there a pattern where you say, fine, this fits exactly, and then we buy it, or that's a country where we only buy or only incorporate? Or how do you decide what you do when you start a new business abroad?
Okay, so it normally goes through the following route. We, year by year, in the budget phase, we define a certain wallet, let me say wallet of money, which we would be willing to spend for acquisitions in the coming year if we have the opportunity. We have a clear view that we try to open for Trilux 2 to 3 new markets any 5 years. So we have limited management capacity, as it is normal for a family-owned business. So we cannot do too much at the same time, otherwise we would not be able to manage it properly. And then we have, as you mentioned before, a different market scenario since nearly 10 years, when the LED came in and, let me say, came into place for the former fluorescent lamp. The business of Trilux became more and more digital. Now we are part of the digital world, because in all our luminaires we have sensors which could also, or which are able to collect data, save data, send data, and therefore the range of the solutions we can offer to the customer has become much wider. And therefore we now not only look on pure luminaire business. If we decide to acquire, we also have to find businesses in which we want to grow, that are business which are close to the lighting business but not part of the lighting business. So for example, we acquired in 2020 a company, CrossScan, in Witten. This company is in stores, in retail business, and they offer data for the owner or for the, let me say, manager of a store. They can measure with sensors how many people are in the retail shop, how high the so-called success rate is. So if 10 people come into the market, how many really do a deal? Are that only 2 or 3? And we decided that we can implement all these into our luminaires, because otherwise you have to do a double work. And that is we call it close to luminaire or behind lighting business, not a lighting business itself. And since that has changed that way 10 years ago, we have also changed a little bit our strategy. In former times, we normally only did 100% acquisitions. Now, because we have limited knowledge in these businesses, we often try only to buy some stakes of this business. So our total, let me say, acquisition strategy has changed a little bit. But if we look on the worldwide business, and if you look to different markets on a more or less geographical level, we still try to buy 100% of businesses. And it is really always, let me say, a question: do we find in a new market a company that is really close to our business, in which we can really find a good partner, that we can say, okay, with this company we do not negative influence our own business. We have a good, let me say, with view on the products, a mix of products if we buy that company. And of course, it was mentioned before, if you decide for an acquisition, you have normally a much faster chance to grow in a new market. If you find a new company, or if you open a new company, it will take such at least 2 to 3 years longer to reach a certain market share. And yes, it is a question of how much money is available at that moment of time, how much will we spend for acquisitions.
Right? And, obviously, as I said, it's all about money, and being a family-owned business,
Yes.
there's clear and no access to the capital markets like a AG or GM, whatever, a different form of a company has, obviously different. But you said the right, or actually, when I listened to you, you said fine. You have a pattern where you say fine. Earlier it was all 100% acquisition or growth. Obviously, if you buy something, then you grow faster to a new market. When it's core business, you'd like to buy 100%, exploring or developing new markets. When it's an add-on to your existing business, like the data business you just bought right now, then rather a joint venture and only a part of the stake. So
Exactly.
what I was just thinking about is, I mean, how do you find? I mean, I understand how you find core business in different markets, because obviously you know your key competition. But how do you find what fits to your business? What is an add-on? I mean, is it opportunistic? People approach you, or do you have a clear-cut vision and say, we look in the world for a company which is maybe providing data for illumination, data for lighting, or I mean, how do you do that?
Yeah, that's a very good question, Klaus. So to be very honest, sometimes, of course, is it opportunistic? We get an information that there is a company on sale. There is a clear set up sales process, and we try to find out if it could fit to us. But on the other hand, we have a department, a small department that really works only with strategy issues. We question how to strategically develop the company in this changing market. So what can really fit to our market, or what will not fit, or to our brand and to our business? So there are both sides, and I would say 70% are more or less own ideas that we really look for a certain company, and 30% comes opportunistically.
And when you go into the market and you try to find a company which fits into your strategy and which is part of what you actually want to grow into, or where you want to grow to, how often does it happen that you try to fish for something and then the fish doesn't take the bait? I mean,
yes, of course it happens relatively often, to be very honest, because the market in which we are playing in, the so-called professional lighting market, is mostly a market of smaller and mid-sized and let me say owner or founder-owned companies. So there are not too many stock-based companies where the ownership is more or less neutral or not very transparent issue. So normally you directly talk to the owner. And you, as I mentioned before, if it is inside our basic business, our lighting business, normally you know each other from, let me say, events like the Light and Building in Frankfurt. You have normally met each other before in international councils or whatever. There are lighting councils. It's a little bit a closed world. And you relatively early learn if there is an interest to discuss about an acquisition or a merger business or not. And if it is not, then sometimes 3 years later, 5 years later, the discussion starts again, or the person you have asked at that time comes back to you and say, okay, now I'm have changed my mind a little bit, and due to old age or whatever, he's now interested to do something. It comes and it happens often. So we meet inside that business rather often, and most of people know each other.
And I mean, how do you, but nevertheless, obviously you know each other when it comes to your core business. You may not know each other very well when it comes to add-ons, because that's when you enter new territory, right?
Yeah.
And but how do you, because I know that from India, very often people just offer their company to test what it's worth in the market and to get some feedback and so on. So how much do you test the seriousness of a seller in the market when it comes to acquisition? Because obviously you said you have limited capacities, yeah, you have certain resources available, and you can't spend your time with somebody who's not really very serious. At the end of the day, whenever you enter into negotiations, yeah, the result has to be there, because otherwise, yeah, it's a worthless effort, right?
Okay, so what we try to do is to bring it as soon as possible on a basis where it is really a serious discussion. So we try to get a signed letter of intent, for example, very early, so that we really try to fix in a, let me say, short form, 2 or 3 pages, what we like to intend to do, to discuss what is our intention, what's the intention of the other part. And if it is signed from both sides, then we get one step further. Then we ask to get, let me say, information. Normally we ask for a virtual data room, for example, so that we can start a deeper check of the figures and so on. That is not already the due diligence, but we can test the seriousness of the willingness of the other side really to deepen that discussion. If you get not a signed letter of intent back, or you will not get any information that you ask for, that is rather early that you really got an idea, is it serious or not?
And at that early stage, you already agree also on a valuation methodology, where you say, fine, in case we come together, this is how we want to value it?
Yes, we try to do. We normally rather say we have to define, of course, the number of years we would like to rely the valuation on, but then you normally, and there are figures public, you all know these so-called multiples on EBIT or EBITDA. It is normally known how our business is valued internationally. So, and then you rather early get, not that you really have hardly defined the figure, but it is clear that you want to take only the last 2 finished business years and maybe the running year, which is now going on, to fix, let me say, the EBITDA basis. And then you can, of course, discuss the multiple later on.
And when it comes to approach in general, I mean, obviously we are here in cross-border. That's our business, bringing worlds together. And in this case, M&A, a buyer and a seller. Is there a huge, I mean, because you bought in Germany, you bought in Europe, and you bought outside Europe and different continents. Is there a huge difference in approach, or does it matter if it's Asia or Europe? I mean, let's not speak about Germany, let's speak about Europe. How would you describe that?
So to be very honest, I would say Europe is not a big difference. Europe is rather, let me say, similar, a little bit separate. I would see the UK because that is a clear capital market. Yes, or a market which is very keen in that kind of business. They are working a little bit different. They do it like you would see in the US. But if you go to Asia, for example, then of course the cultural fit is very important, especially India. You know it. There is always a special issue. It is very interesting what you can learn in India. There you of course have to be much more careful, and you have better a consultant at your side who is really familiar with that culture, because you are really otherwise yes, the only way to do the wrong decisions or to get a wrong picture of the person who sits across you at the table. And I think it's always good to have a person on your side which really knows about the culture of this special market and of the person there.
Yeah, I think yeah, that's obviously also our business where we are in, but not the topic today. The topic today is obviously to understand the differences in M&A and the ways how to acquire and so on. But since you mentioned India, yeah, and obviously India is also one of the countries which I know best. If I look at also at my history, one very typical thing what happens all the time in India is not only that people have maybe an expectation about valuation, which from our point of view maybe slightly high, yeah, let's put it that way, but a typical family business in India runs two books. Yeah, they have an official book when it comes to taxation and so on, what they show, and what is basically the official side of the business, and then they have, you know, the internal books, what really represents the value of the company and the business the company is doing and so on. But coming from an organized background, as we do here in Europe, and regardless, I think it's a family business or if it's a stock traded business, how do you deal with that? Is that immediately a no-go, that you say, fine, we can't deal with that? Or is that something what you will factor in? And if yes, how do you assess if the off the book stuff is really in that range what's being mentioned there? And because I know that many deals fall through because of that, because people don't know how to handle it. But on the other side, it's part of a real business.
To be honest, that is really a thing which is hard to manage, especially if you come from Germany. This is totally different from the way we normally work. We learned that from a Turkish company who liked to acquire years ago. And at a very late stage in the process, when the LOE was already signed, when we had to do the first valuation based on figures, we really found out that there is not very small size of business, a side which is not very official in the books. And then, but that was due to political events in the Turkey, we stopped that discussion. But that was the first time we were really, let me say, aware of this in this region. Obviously not very seldom kind of making business. We learned that in India later on as well. And of course, you have to have it in mind, but it's really not easy to work with this. You have to try to get to figure it out. But to be honest, if you are really always able to get a 100% view on it, it's really difficult. And that is also why it is always hard. And that is what we learned, to do a 50% joint venture, for example, in kind of India, because then you work in parallel in different worlds. If you take it over the business to 100%, you have to make sure, that is what we do, that this immediately stops. For us, it's clear that we only have business which is on the table, which is in the books, that we officially show, and that is our culture. And if we take over a business, we run that business in that way.
Yeah, I think that's obviously self-understood, and I was thinking about the difficulty how to deal with that, with the expectation of the seller, because the seller clearly sees his business as a whole. It doesn't matter if it's in the books, not in the books. It's a business, it's the size of a business, and but I also feel if
Yes, Klaus, it is of course always a question how, what is the idea, the vision of the seller? Will he stay in the business after you have done the acquisition, or will he left the business directly, immediately? If he has already decided to left the business immediately, then of course we cannot calculate that in any way, because that will not happen anymore. If he decides to stay in, and if he's able then, after we took over the shares, to bring it on the official side, what we would like to bring it in, then because of course try to discuss with him that he will get, let me say, a certain money in arrears if he really shows us that this additional worth is really there, or this additional value, what he talked about.
Okay, so that is makes a lot of sense. Obviously, attaching the seller to the values he promised.
Yes.
But I think we are proceeding in time here. So one topic I would like to touch before we come to Alexandre's presentation: post-merger activities. I know that one thing is, to do your proper homework, to find the right target, to assess it properly, to make sure that whatever you put on the table as money, you get value for it. But all of this can be done super and can be super perfect if later on, if the integration process it's not streamlined. I saw that many acquisitions actually did not bring the success which everybody expected to get out of it. And obviously even more though when thousands of kilometers are between the headquarter and those companies which have been acquired. How is that in your case? How do you deal with that?
So at first, a general statement, of course, it's always a people's business. So you have to have people you can trust on. That is always the case. And then it's independent if they are 100 kilometers away, they are close to you, or 7,000 kilometers away. You have to have people on your side you can really trust on. And then our experience really is that the post-merger integration is the most important part of whole acquisition. So if you have done a proper valuation, but you lose 50% of the business in the next 2 years, you have done a wrong thing. And you can rather easily lose parts of the business. So if the cultural fit is not there, if it is not clear what has to be done after the, let me say, closing has taken place. So we try to set up always a proper, let us call it 100 days plan. And we have a person always on site who really follows up that plan. And of course, before you define that 1 day plan, have to see if it really matches with the culture of the company that you really require. You can easily set up a plan on site on your desk here in Germany, and then you go abroad, try to bring it in, but you rather soon can recognize that it will not fit with the culture in front of that business totally. So we have made this failure in Germany as well, when we bought a rather small company and we had already decided to bring in our SAP system within the first 100 days, and we nearly killed that company in that 100 days. So that is, even if it is in Germany, you always have to really recognize and to understand the culture of that business, and then you have to do a very careful integration within the first 100 days. And the clear difference is, and it really differs, if the former owner or managing director stays on board or if he leaves after the acquisition. That's a total different story then. And if he really leaves, of course, you have to take care that you have a person there that really is able to steer that process.
Okay, so what I understood, and that is also my last comment, my last question to you. What I understood, obviously, is you do your homework properly when you buy something, but have a clear understanding of once you bought it, how to integrate it, and you also need to have the resources. Because if I understood correctly, said if you don't have the resources, don't buy. the resources
Right.
for integration,
Yes.
and not the resources to do a due diligence or whatever, but specifically the resources for integration.
Yes, very important. And if you do not have it on your own side, of course, you can also buy such a, let me say, person or such a knowledge. You engage a person who is really very, very, let me say, experienced in that way. And there are persons on the market who are able to do that job then for 100 days, for half a year, whatever, and to help you to really integrate that business successfully.
Yeah, especially in the intercultural context, I think that's also
Yes,
one thing which has been done by us quite a few times. Because
yes.
you're right, you don't want to waste money. Yeah, I mean we have limited resources, and but for many companies, I also agree. And then I want to close this interview with you here. Many companies do not see that. They do not see that basically at the end of the day, I buy something. But when I bought something, I have to make sure that it fits into my organization, or that I make it fit in a way which is culturally acceptable.
Yes.
Perfect.
Most
So no,
important.
Oliver, thanks a lot. Yeah, and I'm sure that later on there will be a few questions by the audience. So if you maybe stay now in the back, and we leave the stage for Alexandre. Maybe Alexandre, you come up, and later on we just answer a few questions of the audience. But thanks a lot. It was great information, and I'm sure that many people now will look maybe differently at what they're going to do, how they will expand internationally, globally, by buying a company. But thanks a lot, Oliver.
Okay, thank you for giving me the chance
Okay.
to explain something. Thank you. Okay.
Thank you.
Bye.
Thanks a lot, Klaus, Oliver. Hello, everyone. So I'm Alexandre KAPLAN, head of the corporate finance team of the group. So I joined the group after 7 years in London, so in various M&A advisory firms, including, as you may have noticed with my accent, I'm French, so including the French bank Société Générale. So I quickly specialized myself in the buy-side aspect of an M&A deal, so advising groups in their international strategy and cross-border deals, and very happy to speak today on this very special topic alongside Klaus and Oliver that you just heard. Maybe we can directly switch to the next slide and make a first assessment. Really, the first assessment with this COVID context is that COVID has really accelerated the change of strategy for SMEs. So a lot more companies really have been rethinking, rebuilding their international approach, and often M&A is seen as one of the leverage for growth. So a quick illustration about the figures on our side, Altios MNV. So we have seen an increase from 10 projects in 2019 to over 50 today. So really a huge change of approach, and it's mainly the case for companies with a revenue level above 15-20 million euros and up to 250 that really are willing to go quicker than a pure organic growth that can sometimes be too heavy, too time consuming. And they prefer to secure an existing presence by acquiring really another company with an established brand, employees, a portfolio of clients, and already existing revenues, and ideally existing profit as well. So we can switch to the next slide, where the idea is really to present quickly our distinct approach to M&A compared to other advisory firms. So we decided to be very specialized in this very niche approach. The first section is that we are working almost exclusively on the buy side, meaning advising the buyer in its international acquisition strategy. So we are active on what we call the small and mid-cap category, meaning that we are working on deals with an enterprise value of 5 to 50 million euros, even if, of course, we have some projects going up to 100 million and other with values below the 5 million euro level. For example, and just to give you an idea, the latest deal we've closed had an enterprise value around 2.2 million euros. So we can go with smaller deals, but 80% of our pipeline is in this range. So quickly, our involvement goes from, of course, the market screening up to the closing, and our model is really to be the recurrent advisor on multiple deals in several countries for a buyer in its international strategy. So really the idea is to add value, to be efficient when considering several countries in parallel. Finally, the last point that really differentiates us from other advisory firms is that we only work on cross-border deals. So we avoid working on a domestic market because the DNA of the group and the real value of our model is that we bridge intercultural specificities. Maybe we can switch, please, to the next slide and assess a few elements of the model that really is important when you consider an acquisition abroad. Is the fact that having a unique advisor when you consider several countries at the market screening phase to find the ideal target for your strategy is to really understand and assess the best countries and the best target if you want to do one or several acquisitions. Then really having a presence in the country with local team really enables us to be impactful. And it was mentioned previously by Klaus and Oliver, to have this knowledge of the specificities of a country. And when you do a market screening with or without an advisor, it's not only a database export. The idea really is to have an exhaustive list of relevant targets. And to reach this, really, you must have a strong network locally, knowledge of all the different ways to find the ideal target. So compared to other typical firms, big investment banks that will mainly work with companies that have been groomed, prepared for a sale and for a full M&A process, the DNA of the group is really to approach companies that are not actively selling. So the idea is to create the opportunity and test their willingness to discuss. This is why it's always better when you approach a company to present a strategic partnership rather than a pure financial deal. The idea, again, don't forget it, is to create value and to go to the closing. Maybe now we can switch to the next slide and come back to the key steps of a usual M&A process. So basically, here on the slide, you can see that you have 5 really important steps. It sounds a bit like school, but it's always nice to have a structured process because it's a process that takes sometimes more than 18 months, and so you must structure it properly. So basically, first step is to define the ideal target. This is step 1. Then do a market screening based on the defined criteria. And the idea really is, based on this first list, you can select the most relevant companies of the list that you want to approach. And this is phase 2. The idea when you approach companies, it's to prepare the approach. We'll come back to this afterwards, but you don't approach a company the same way in Asia, Europe, and the US. We'll come back to that. And then when you do the approach and you have a first feeling of an interest, then you start phase 3 to organize a meeting with the target, go and visit physically, because first of all, it's a human adventure. And then you start to discuss the pricing, the synergies, what can we build together, whom people do you want to stay, and so on. And so this will set up, and I think it was mentioned earlier by Oliver, this will set the first parameters of a non-binding letter that will kind of write on a paper the first conclusions of a potential deal. And once this LOI is signed by both parties, don't forget really to do this phase 4 of due diligence phase that will cover financial, fiscal, social, environmental, legal aspect to verify that really the company you are considering is clean and is confirmed what you saw on the website, on the discussion with the seller. So don't forget to really insist on that phase. Then, if all is okay, both parties will draft what we call the contract, it's the SPA, up to the signing and closing of the deal. And if all the conditions, suspensive conditions, as we call it, have been cleared, you can do the closing. And then don't forget that it's just the beginning, because you have the integration phase that must be done properly, and it's a work almost equivalent than doing all the deal. It was a small reminder of how to run an M&A buy-side process. Then maybe we can switch to the next slide, and before a few prerequisites, I would say, before we start an M&A project. How must we well prepared? The idea really here is to maximize your chances of doing a successful deal. First of all, it's important to name an internal M&A project manager in your company. It will be really the operational person that will interact with all the different parties, advisors, if you have some, M&A, auditors, lawyers, but also the internal people in the company, the CEO, the investment fund if existing, a family if they own the company. So really, there is a need for a person that will allocate time for the project. And it's often the same person who will be involved in the integration process. This is the first thing. Don't forget that it's a process that takes time and energy. So it will come sometimes, and we've seen this a lot, on top of the usual daily work of a person. So you must really define a person to do this. Then on timing, it's a long process, in average 1 year, often up to 18 months, sometimes more. So it's really important to have an idea of the timing, as it requires time and energy, especially when you want to partner with a company abroad. Huh? So really, it can go quicker than organic growth, but it still takes time if you want to find the relevant company and integrate it properly. For example, we recently advised a Belgian firm in its acquisition of a Spanish firm in the pet food sector, and 1 year after launching the project, it's still ongoing, and we are close to an LOI, and we hope to finalize it in a few months, but really it takes time. They've been prepared for it, but they really want to find the ideal and proper target and not to buy the first company willing to sell. So really, don't forget the timing. Then it's not easy. It's a complex process with a high number of barriers, especially abroad when you have to deal with cultural specificities, valuation differences, and sometimes, you know, and I've seen this a lot of time, the ideal target simply does not exist, and we have to be flexible and creative. It's like when you decide to buy a flat or a house, you need to do some adjustments. So doing the M&A deal, it's defining why we want to do an acquisition. Is it to enter a new country, to consolidate existing operation? Is it to buy, I don't know, specific technology, a specific brand, specific accreditation? Really, those questions come in the preparation phase. And of course, it's mandatory to take the time to really identify your ideal target, and we hope it exists. So the activity, the turnover, are we looking only for a profitable company or a company with a high level of synergies, with a specific EBITDA margin? How many people? All these questions, put it on paper. Of course, there's advisors to help you really prepare this, but then you have the proper vision to, I would say, begin. Don't forget also what what kind of deal do you want? Is it only 100% acquisition, or will a progressive capital increase be an option for you? Do you want to keep the managers for a transition period for maybe a few years, which I always recommend? So all these first elements really important to solve before beginning the project. We can switch maybe to the next slide, which will detail the key steps we've seen together. Maybe we'll go through some key aspects step by step. So the first risk on this first phase of the screening phase, the first step is to be tempted to do it too quickly, and by approaching too quickly the companies. So really, what's important is to take the time to be as exhaustive as possible in order not to miss the ideal target. This requires really to have a network in place in the country and all the leverage to properly identify these companies. It's not only visible on a database. Really, some companies needs time to be identified. For the duration of this phase, and of course it depends on the sector, on the market, and so on, but it's at least 6 weeks, often 2 months, to do really a proper exhaustive search. And it's not because there are only 10 or 15 companies in the market that they're easy to find. So it's not only the number of companies in a market, it's the number of companies in the market and the difficulty to find them that will I would say assess the duration of this period. So identification is the first thing. Then what you need to do is to properly qualify the targets. So what does qualification include? The financial information, of course, and this access to financial information varies from one country to another. I think it was mentioned by Oliver at the beginning. And this varies in some countries, even in Europe. In the UK, for example, companies tend to publish their accounts. It's public information. You go on company's house and you have normally all the accounts, whereas in Poland and Germany, it's sometimes harder to get the accounts, especially for small companies. In France, most of the accounts are public, but some companies decide not to publish their accounts, even if they have to pay a fine for this. So for non-listing companies in France, it's mandatory to publish normally your accounts to the greffe, the Tribunal du Commerce, but some companies decide that they don't want to publish it. And so in that case, they pay the fine. So you don't have always the access to this. But for you to make the decision if the target is properly qualified or no, you need to have an idea of the turnover, sometimes of the EBITDA. So really, this access to financial information varies among countries, but usually it's quite easy to have a first idea. Same thing for the ownership. Really take the time to identify who are the owners of the company. Is it a 20 years person that created the company 2 years ago, or a more experienced manager of 80 years? So really, it's not the same if there is an investment fund at the capital or a 3-generation family on board. So really take the time to identify and qualify your list. On the approach phase, and I see the time flies, so I'll go quicker. There's a need really to align on the methodology. Do we approach on an anonymous basis or not? Do we approach with a formal letter? Sometimes in Germany, this works perfectly. In UK, Spain, Italy, it's not surprising to approach owners on LinkedIn. For example, it was a few days back, we approached 10 companies in Spain purely on LinkedIn, and we got 6 answers in less than 2 hours in the fleet management sector. So really, it's really a case-by-case basis. It depends on the country, on the sector, and the nature of the owners, but really take the time before you act. Don't act quickly, prepare, and then you can act, and this will go a very smooth way. And before we switch to the next slide, a last recommendation. When you have a first, I would say, discussion with a target, please do not ask the level of EBITDA and the desired price after 2 minutes of conversation. It's the best way to fail the project. So really there is a need to create this positive atmosphere and trust. And this goes most of the time by putting in place an NDA and sharing the industrial project with the synergies you want. We can switch to the next slide, which is more the valuation aspect. So when talking about valuation, valuation multiples are really very different depending on the country because of the cultural specificities, the fiscal environment. So what prevails here is to be cautious, I would say, on the way we value a company. It's been mentioned earlier. We have different methodologies to value a company. This, first of all, goes through the proper analysis of the adjusted EBITDA. So what you see on published account is in most cases very different on the true normative recurrent EBITDA that you must build, rebuild, and sometimes be confirmed by an advisor. In many European countries, you have no misuse of corporate assets. So the profit disclosed in the accounts can be quite similar to the true profit of the company, but in other countries like the UK, it's not unusual to have some personal expenses of the sellers that impact, of course, the profit, and that needs to be reintegrated. So really, take the time to really analyze all those adjustments to the EBITDA. Don't forget as well to do the proper due diligence to verify that the company is healthy. And as mentioned, and maybe I'll finish on this and it will be perfect on the timing, to do the proper diligence to verify and to be sure that you will maximize the value of your acquisition, and you will need, of course, to pursue and implement the synergies you wrote on the paper, and sometimes to find some clause to keep all the customers. And you will need to manage employees, the IT system, and develop the interactions between both entities. And this is what we are doing, Altios MNV, and it's working perfectly. So one advice on this step, really communicate, communicate, and communicate. It's always better to have too much communications than too little. And I'll finish on this. Once you properly digested your first acquisition, you can start the second one. Thanks a lot. And maybe if I have time, Thomas, to do 2 minutes on the case study, or we can directly switch to the Q&A as you want.
You have 5 minutes.
Super. So on the case study, basically, as you can see, we've done this deal for an Italian company called Tinexta, active in the financial innovation sector. They've gave us the mandate to acquire a company in France. It was in April 2019. We start the mandate. We've made a list of, it was 10, 15 relevant companies in France corresponding to the scope. Euroquality was one of the targets identified, and the one that our client wanted to discuss with. So we approached this company. This company was open to discuss for an acquisition. Quite quickly in the process, they were a financial advisor on the other side, so it sometimes helped to go quicker. So we made the list, 2 months, this approach phase, 2 months, a first, I would say, discussion with the target it was just after the summer in September. Then we have like 3-4 months of discussion on valuation, the price, and we finally signed this letter of intent that will fix all the parameters in December 2019. So as you can see on the timing, we started the mission in April, first LOI in December. So, but it's usual. We started the due diligence the next year, so in 2020, and the due diligence was a bit longer than expected because we had to do we had to rebuild the audit of the company because it was a small company. So the due diligence took us 6 months. And finally, we did the SPA in September and the signing early October, the closing early October. 3 things on this. The 3, I would say, main difficulties is the fact that we had really a big gap between our client, a listed Italian group of 250 million euros, doing 5 acquisitions per year, our client, and then a target, a small French company around 5 million turnover, first time that the sellers was experiencing an M&A project. So you had really 2 worlds, and to discuss, this is the role, of course, of the advisor, is to bridge this gap. And really this difference of approach, of valuation, and on top of this, the fact that it's Italy and France, really bridging intercultural specificities has been key. And sometimes you need to speak French with a French, Italian with Italian, and this is why here the model worked, because bridging the gap is of course, speaking the same language, understanding how a seller will analyze his accounts, and explaining to our client that in France you don't value the company the same way as in Italy. So all this stuff has been our work, and this is why also it took that long, because you had a lot of education for both parties to make this happen. And also, of course, when you have a small company that is integrated in a bigger one, you had to adjust some more technical stuff like GDPR compliant. Of course, the small French company of 5 million euro was not at the same level of GDPR as a big listed Italian group, so you had to cope with the difference. Same thing on the accounts. When you have a company that is led by a French owner, 5 million euros, it's not the same accuracy than a listed Italian group on the accounts. So same thing, you had to do an equilibrium, and we had to audit and to rebuild properly the financials. So all this stuff took time, but finally we succeeded, and I spoke to my client a month ago, almost 1 year after the acquisition, and it's going perfectly. Integration is happening, and all is working really well. So a conclusion on this, and I think my 5 minutes are finished. Be patient, be creative, and of course, be diplomat. It's always better. Thanks a lot for everyone, and happy to answer if you have any questions at all.
Thank you very much, Alexandre. Very nice speech. I also have a question here for Mr. Thyssen, if he's still with us. Otherwise, I can also start with the question for you, Alexandre, or maybe Mr. Thyssen. I don't know if the question goes a little bit too deep, but it is basically, what was your biggest failure in the post-merger phase?
Yeah, I think that I tried to explain it before. When we made an acquisition in 2007 in Germany, we bought a company that was really an owner, yes, an owner-led company, and the owner left the company immediate after we have taken over it, and then we tried to integrate it as soon as possible because we had the idea that otherwise too much of this business would get lost, and this integration process that we then defined was definitely much too fast for that company. We lost the people, and the people left the company. A lot of the people left the company, and one of the major faults was that we decided to bring in our SAP system very, very soon. And it was in the long run the right decision to bring it in, but not within the first 100 days because we really left the people. We lost the people. And that was a big, big mistake.
Okay. The second question is in direction Alexandre, I guess. On the 50 projects currently active in MNV Altios, what is the geographical split? I mean, the question is basically we had also a lot of BRIC events, and then Asia is growing fast, so that's geographical split. Where do you have most projects, so to say?
Yeah, no, it's a good question. So maybe I'll answer on the geographical split of where we do or where we try to do acquisition. So like the country of the target, if you prefer. Basically, so on the 50 project we have 80% in Europe, 10% Americas, and 10% Asia. I would say, even if it's true that the trend for Asia is going up. And in Europe, it's really a mix, I would say, between France, Germany, Spain, Italy, and Eastern Europe, mainly. And we have one project in Switzerland, one project in Belgium. Yeah, I would say this is the four main countries on the 50 project, and it's been the trend since 18 months. It's France, Germany, Spain, Italy.
We already come to the last question. It's a yes and no question, but please don't answer with yes and no. And it's basically, I think, for both of you. Maybe you start, Mr. Thyssen. Do you think it's possible to do a deal 100% digital? This is because of the COVID, we cannot travel, and so on and so forth.
No.
Yes, that's exactly the answer that I expected. Maybe you want to explain a bit.
Yeah, it's a pure yes or no question, yes, but I say no, because you have to have a direct contact, at least with the seller side. As I mentioned before, we normally talk about owner-led companies, and you have to meet this person. You have to understand the reasons why you want to sell. You have to understand the culture that he gave to that company. Otherwise, you would be lost. And I think there are some things you cannot do digitally. There is a lot you can do. We have all learned, I think, throughout the last 2 years that there is more possible than maybe most of us have already expected. But I think you need the direct personal approach in these businesses.
Alexandre, for you, your experiences, maybe you also want to reply with a yes or no?
Yeah. Well, I've heard a legend that some did it 100% digitally, but I would say I'm quite in line with Oliver. No, really, it's a good question. With the COVID, basically, we really changed the way we work. Just to came back maybe on the process. So for the screening and the approach phase, no change, to be honest, because it was already done digitally. Maybe a little more LinkedIn and mail than the posts. This is maybe the only change, but what really changed was the meeting between a client and the target that we used to run physically before COVID. Now with the Teams meeting, to be honest, it's going really well. It gains time and money for everyone. But when it comes to hard negotiations, and on this, I agree with Oliver, it's always better to meet. And maybe on the seller side, just to add that there's always a large level of emotions, especially when it's the first time you sell your business. So, I mean, it's normal to see physically who's buying you. pretty sure they won't accept to sell their company to a screen. But for the rest, I would say due diligence, SPA. I mean, with COVID, all of this have been properly digitalized, and with all the relevant tools like DocuSign, all is going really smooth and quicker, to be honest. So a closing 100% digital in theory, yes, but in practical, no.
I want to thank you very much for your participation. I hope that our guests also like this. In case you have further questions, or you also just drop us an email. We are happy to reply, and hope to see you all soon again. Thank you.
Thank you.
Bye.
Bye-bye. Thank you.
Bye-bye.
Bye.